Ben is the Director of Institutional Asset Management at Ritholtz Wealth Management. He's the author of 4 books, a columnist for Fortune, the creator of the blog A Wealth of Common Sense, and co-host of the popular Animal Spirits podcast. Ben is a native of Traverse City, former St. Francis running back, I believe, call that, and a graduate of Hope College. So let's give a warm welcome to Ben Carlson.
Pretty sure I attended Homecoming 1999 here. So, okay, so just a little bit about my background here, a little bit more. So I work for a company called Ritholtz Wealth Management. It's an RIA based in New York City. Our whole business model is predicated on the idea of we give away content for free to people, and they kind of find us on the internet. And if they like what we're saying, they trust us, they come to us, and they give us their money and help us manage their wealth. Assuming the market cooperates this year, we'll have grown from $140 million in management and assets under management when I joined in 2015 to probably $3 billion. And it's lucky I could write a little bit. So I have a blog called The Wealth of Common Sense. My dad used to be a member here, and on my best day, I could maybe break 100 on the golf course. So the fact that I could not have to go there to find clients and I could just write and people could find us that way helped a bit. Jeff said I wrote 4 books. I think people bought 2 of them maybe, so it's not bad. I do have this Animal Spirits podcast where I talk about the markets every week and what's going on in my life and personal finance and the economy and all these things. And one of our new ventures is we've started this YouTube channel called The Compound. I've written for a bunch of different publications, and I've gotten Amazon reviews. By far the meanest people in the world on the internet are on YouTube. You never read those comments. A little about my agenda today. I'm going to talk about the 8 biggest myths of investing. This is kind of some stuff I've put together over the years of all my writing. I'm going to talk about what they mean for today, as the markets are sort of a little crazy, what it means for you as an investor, and then maybe I'll leave some time for some questions. So I want to start today with a story about my friend named Bob. Bob is the world's worst market timer. So Bob is a boomer, so back in the 1970s, he said, all right, I'm going to plan out my entire retirement savings strategy. So in the late 1970s, he said, I'm going to start saving $2,000 a year, which in today's dollars is 9 or 10 grand. And every 10 years, I'm going to increase that amount by $2,000. 2019, I'm going to retire at age 65. I'm going to plan it all out. He was, very anal about these things, but he said, all right, so the problem with Bob is he really didn't know how to invest that well. So he kept his money in a checking account for a few years, and he finally said, all right, it's the early 80s. Hopefully the markets are turning around a little bit. Late 1980, I'm going to take my money and put it in this new S&P 500 index fund. And unfortunately, Bob invested at a really inopportune time. This is when inflation was raging. There was 2 recessions in the early 1980s. Bob's first investment came right before this close to 30% crash in the market. So Bob's very first investment, he invested right at the market peak, got crushed. All right, so this is, early 1980s, death of equities. It's not a very great time to invest for people. So Bob was a little nervous. He said, all right, that one didn't go so well. I'm going to leave it in the market, though. All right, I'm not going to touch it, but everything else from here, I'm so nervous, I'm going to keep it in my checking account until I'm ready to invest again. Because I don't know, I don't feel right about buying. But he had one saving grace, and he never sold his first investment. So that's a key point here. So Bob's second investment, he says, all right, it's fall of 1987. The stock market's looking pretty good. It's been doing well. Let's do it again. This time he put his money in. He had $16,000 this time. Put it in, worst one-day crash in history. 1987, right? 22% in a single day. Stock market lost 34% in a single week. Bob's 0 for 2 on his purchases now. Both purchases he's made right before a huge market crash. All right? Third investment. It's been a while now. He's burned really bad the first 2 times. That 1987 crash left a lot of scars. So he sees the whole 1990s run up. We have this dot-com boom. Technology stocks are going crazy. Bob sits it all out. He's putting all his money in his checking account still. 1999. All right, I got 54 grand. Let's do it again. Right into the hottest market of all time. Huge crash. Stock market falls 50%. Bob's now 0 for 3. Okay? 3 times he's put his money in at a peak. Again, he put that money in and he kept it there. But after that, he said, I'm going to keep it in my checking account until I'm ready again. All right, one more time. This is my last investment before I retire. October 2007. Right before the great financial crisis, the stock market falls 56%. Bob is just deflated. He invests right into the Great Recession. So Bob made 4 purchases in his life, over 40 plus years of investing. Always at the top. Right before the 1980 crash, there was inflation, the biggest one-day crash in history, the dot-com bubble and bust, and then the great financial crisis. You can see on this chart here, 4 of the worst crashes of the last 40 years, right? Bob invested right before all of them. So how do you think he did? So 4 investments, he kept it in cash until after that. Bob was a millionaire. He saved probably 200 grand in total, ended up a millionaire. How? First of all, whenever he made a purchase, he never sold. He stayed in the market 4+ decades, especially with his first purchase, left it compounding. He kept saving. He never stopped saving. He increased the money saved over time, and he had a really long time horizon, right? So even with all those mistakes, a long time horizon can kind of weed that out and make it doesn't matter anymore, right? Now, what if Bob didn't get so nervous? What if instead of investing only at market peaks, Bob said, you know what? Every time I get paid on a monthly basis, I'm just going to put it into the market. I'm not going to think about it. I'm going to dollar cost average, and I'm just going to have it set it and forget it. $2.5 million. He wouldn't be the worst market timer in the world if he did that, but that's kind of what happens. So this gets to my myth number 1 is that you have to time the market to be successful as an investor. And it's just not true. If you wait for everything to be perfect to invest, you don't just put your money in, it's probably not going to work out great for you. So even being the world's worst investor like Bob and putting it right at market peaks, maybe we had one of those a couple weeks ago, you're still going to be fine. And that kind of gets us to this second myth. I think this is Bob's second problem. I'm just going to wait for the dust to settle. Then I'm going to put my money back in, right? When things are too crazy and uncertain, I'm not going to invest. So during the pandemic, right, we had this unemployment rate went from under 4% to 15%, basically overnight, right? It was crazy. We had clients calling us saying, you got to get me out. This is too crazy. Look at the unemployment rate. Look what's happening with the pandemic. Yes, the Fed is flooding the system with money, and the government's sending out checks, but they can't stop a pandemic, surely, right? This has to get worse. Unfortunately, you can't wait for the good news to happen until you invest. By the time the good news hits, it's already too late. So this was down in West Michigan where I am now. This is trucks hauling out the very first dose of the vaccine. By the time this was rolled out, this is where we are in the market. This is the crash in the pandemic. Isn't it kind of funny we thought this was the end of the pandemic, right? The vaccines are rolling out. Surely I did. It's over. The stock market was already up 66% by that time, right? So the stock market is past new all-time highs by the time the vaccine gets rolled out. So you wait for that headline to hit, and it's too late already, right? The stock market has already moved on. And this is the kind of thing where going into 2020, I could have given you all the headlines in the world. We're going to have a global pandemic. People are going to be in their houses for 2 months. Everything's going to shut down. People are going to quarantine. Hospitals are going to fill up. How would you have invested? I would have buried the money in my backyard, right? The stock market was up 20% that year. So I could give you the headlines ahead of time, and it still might not help you. Now you might say, well, the pandemic, that was this one-off event. The government threw all this money at it. That's different. That doesn't matter. How about the 2009 bottom? So this is the unemployment rate. Going back to the early 2000s, you can see the spike from the Great Recession in 2009. This is where stocks bottomed here. The unemployment rate was still rising. And the unemployment rate actually kept rising for 7 months after the 2008 financial crisis and the stock market bottom. So the stock market bottoms in March of 2009. It races up 70% to October of 2009 when the unemployment rate finally topped out at 10%. And so you wait for that good news, and it's too late. Same thing happened. Remember the whole reason for that happening? We had this big, huge housing bubble. Housing crashed. The stock market bottomed here. So this is the Case-Shiller housing price index. So you can see that big crash, the biggest crash we ever had in housing. Housing bottomed in 2012. By that point, the stock market had already moved on and just said, we don't care anymore. And by the way, just as an aside, I'm not one for making predictions. That's not my thing. I'm usually providing context and trying to put things into perspective. If I were a betting man and I had to make a prediction, let's call it 95% confidence. You see the housing prices now are way higher. And if Bob had been an investor, do I have a little pointer here? If Bob had been a housing market investor, he probably would have bought right here, 2006, right? Had he held on, he's up 50% on his house, right? So you buy at the peak of the last housing bubble and held on, you're still doing fine, right? Obviously, you had to see your house crash in price and hold on to it and not get completely taken out by the debt on that. But so back to my prediction. It looks like we're in a housing bubble right now, right? Again, I'm not one for this. I would be shocked if housing prices aren't materially higher by the end of this decade. We have the biggest demographic in the country, millennials, who put off home buying because of the great financial crisis, because they were going to school longer, because they were going back to graduate school, and they are in household formation years. If you think they're not going to buy all the houses that are on the market, you're crazy. So that's my one prediction. Housing prices are not going to crash. All right, one more. This is the stock market versus the unemployment rate. This is my first book, A Wealth of Common Sense. I didn't update it. This was written in 2015, but still probably pretty close. You can see the best returns happen when the unemployment rate is the worst. How can that be, right? Because that's when stocks are crashing. We're in a recession. The best time to buy is when stocks are down, not when they're rising, right? Myth number 3. Well, all right, I'm just going to wait for things to get to normal. Once things normalize, interest rates normalize, stock market normalizes, the economy normalizes, that's when I'm going to put my money in, right? I'm still trying to figure out what normal means. So this is the inflation rate going back to the early 1900s. You can see it's obviously not as volatile as it was in the early 1900s and 1920s. The long-term average is roughly 3%. You can see we're currently well above that at 7, but I'm trying to figure out where normal is on the inflation rate here. It's always all over the place. Same thing with interest rates, right? So this is the 10-year government bond going back to 1920, so the last 100 years. So you can see from 1920 to 1960, call it, we had this range where rates were basically 2% to 4% following the Great Depression. Then from 1960 to 1980, rates screamed higher and went to 15%. And ever since then, they've been falling. I don't know what a normal interest rate environment looks like if you look at that graph. It just doesn't really exist. So it's kind of hard to find a pattern in all these things. So I did this chart where I showed, by decade, the stock returns and the bond returns and the average interest rates and the GDP growth, inflation rate, all this stuff. And like we're pattern-seeking creatures, right? This stuff makes us feel good. There's been studies done that show if you show someone that happens 2 times in a row, they automatically in their brain think a third time is coming, right? So people do a coin flip contest. If we did it with everyone in this room, and we kind of had a one-on-one, eventually someone would be the winner. They win every single coin flip contest. If you did that, that person would think they can guess, even though every time it's 50-50, right? Because that's how our brains work. But with the markets and the economy, there really is no pattern here. You can't say, if this happens, then this is surely going to happen next, right? It doesn't work like that, unfortunately. All right, myth number 4. I don't want to sound judgmental. This room is skewing a little older. So I think people here probably are in for yield, right? Like, and the idea is when you're retired, you think, well, a higher yield must mean a better investment, right? It's got to be safer. I want that yield, especially in a world where bond rates are on the floor. Like, I need the yield. That's how I'm going to retire, is I'm going to do yield. Unfortunately, sometimes the yield doesn't tell you everything about an investment. So this is AT&T, blue chip stock, right? Everyone's heard of it. Everyone knows it. They take me for like $500 a month between phone and cable and internet and all this stuff. So over the past 20 plus years, their average dividend yield's like 5%, right? Pretty good. Every year I can clip that coupon. I don't care what happens to the stock price. I'm clipping that coupon. I'm doing fine. Unfortunately, look at the stock price. It's down 50% since the early 2000s. So if you bought AT&T because, well, it has a high dividend yield and being paid to wait, you got crushed. So since this time, since 2000, you would have done better just sitting in boring old bonds than buying AT&T stock. This one's a little different. This graph's a little different, but you can see this is GE. This was everyone's favorite in the early 2000s. You can see that big spike in 2008. That's because the stock crashed, basically. Now, this one was basically a 3% dividend payer for years and years and years. Kind of helped that they manipulated their books back in the day, but that's another story. Not like it's not finally see that they cut their dividend. So for 20 years, you think, I'm clipping 3%, I'm doing great. Stock's down 75% since 2000. Now, I'm not saying, well, don't invest in dividend stocks, because my firm has dividend strategies we use. We buy a basket of dividend companies, and we try to make sure it makes sense and diversify. But the point is, like, buying on this one variable alone is not going to tell you everything you need to know about an investment. You have to look further than that. I actually think, as being kind of a simple guy, your best hedge against inflation and buying yield is just the overall stock market. So this is the S&P 500 going back 100 years. This is the real after-inflation dividend payout of the S&P 500. So you get going up over time. So over the last 100 years, the dividend rate has grown at 5% real after inflation. So even taking inflation out, you're growing over and above it. So even though you think, geez, the dividend yield on the S&P 500 today is like 1.8%, that's nothing. What am I going to do with that? And that doesn't sound like very much, but it's rising every year. It's not like a bond where you're earning that same yield every single year no matter what. It's going up over time. It's a good hedge against inflation. One more. I did this presentation a couple weeks ago. This is going to sound like bad timing because the stock market feels like it's crashing right now. But new highs in the stock market does not mean it's necessarily going to crash, right? You look at an over a long-term chart like this and you go, there's no way this can last, right? I've lived through 2008. I've lived through 2000. It's impossible, right? So this is new highs in the S&P 500, the U.S. stock market, by decade. You can see the 2020s already, over 100. Last year alone, there were 70 new all-time highs. And I think 2008 conditioned a lot of people that lived through it to go, all right, we're back here again. That means we're going to crash immediately, right? Unfortunately, that's just not true. We did a study internally where we looked, if you decided to buy and hold the S&P 500, or just buy when the stock market is at new highs, you actually almost outperform a little bit if you only buy when the stock market is at highs. You think, well, that doesn't make any sense because it's going to crash eventually on lows. And of course, it does. One of those highs is going to be the high for a period. But there's this momentum involved that it happens a lot. So 5% of all trading days, go back 100 years, every single day on a daily basis, 5% of all days, that means 1 out of every 20 is a new all-time high. Now, the inverse of that, unfortunately, means 95% of the time you're in a state of drawdown from an all-time high. But that's kind of the nature of the beast, I guess. And then there's this gambler's fallacy idea that, so you're at the roulette table, and you see it hit red 10 times in a row. And you go, I'm just going to keep betting on black until it happens because the odds are in my favor, right? Unfortunately, the odds are always, Dad, what it's not 50-50. If you take the 2 zeros, right, it's 48. Anyway, it's close to, we'll call it 50-50. You think if you see a red every time in a row, the next one has to be black, right? Unfortunately, it doesn't work like that, right? Because the odds are always the same for every single spin. Same thing is true of the stock market. So let's say I gave you last year the stock market was up. What's it going to do this year based on last year? Average? About 11%, which is pretty much average. All right, fine. Stock market is up. Let's say the stock market was up 10% last year. What is it going to do the next year? Average is about 11% again. Fine. Stock market last year was up 28%. So let's say, okay, the stock market is up over 20%. What happens the next year on average? About 10%. Okay, fine. 30%. You can't possibly be higher, right? 9.9% on average. Now, of course, the range around these averages is wide enough to drive a truck through. But the point is, you can't just say, well, last year was down, so next year has to be up. Or last year was up, so next year has to be down. It doesn't really work like that. On average, the stock market is up 3 out of every 4 years. It doesn't work exactly like that, but that's kind of the long-term average. The other idea is, and this is, I think, probably Bob's problem, I'm just going to wait for a pullback. Stocks pull back, then I'm going to buy, right? Stocks pull back 10%. This guy, Sam Lee, that I know, wrote this piece called Waiting for a Pullback, and he said, what if you just sat in cash and waited for a 10% pullback? And I'm only going to invest when it falls 10%. That's the blue line. Orange line is just buy and hold, just stay in the market. It sounds really smart to, I'm going to hold some dry powder here. I'm going to wait for a correction, then I'm going to put it in. The problem is, most people, if they do that, so let's say you held and you waited 6 years for a 10% correction. By the time that 10% correction gets there, are you really going to invest? Or are you going to say, I'm actually going to wait for 20%. Then 20% comes and you go, all right, now I'm going to wait for 30. And 30 never comes. Then you never get your money invested, right? So it's so much easier to just be in the market and not worry as much about when you're going to enter it. Number 6, the stock market is like a casino. We heard this a lot after 2008, right? I would also accept a roller coaster here. Those are the pictures you're probably going to start seeing on the news today. The stock market is down, so it must be a roller coaster. The thing is, if the stock market actually was a casino, the longer you played in it, the worse your odds would be. I've been to the casino before. They have the odds, right? They have a small advantage in every single game there. And so the longer you stay, the higher probability that they're going to beat you. The stock market is different. So this shows different time horizons. So this shows on a daily basis. You can see daily basis, 56% of the time the stock market is up, meaning 44% of the time it's down. It's almost a coin flip on a daily basis. It's just a slight edge being up. Go out a year, like I said, 3 out of every 4 years, stock market is up. 5 years, we're talking about almost 90% of the time, stock market is positive. 10 years, 95, and then there's never been a 20-year period after accounting for dividends that the stock market has been negative. Now, this doesn't include things like costs and taxes and inflation, all this stuff, but still pretty impressive, right? Remember a few years ago, a lot of people were worried about like high-frequency trading, and Wall Street is screwing me over, right? They're taking advantage of me. Well, Wall Street plays here, right? They play on a daily basis. That's short term. You don't have to play there. You can play here, 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 right? The longer your time horizon, the better you do. And so this is a chart I made of the rolling 30-year returns in the U.S. stock market. You can see it's all over the place. Sometimes better, sometimes worse. Well, let's say you had the worst luck in the world like Bob, and you bought in September 1929, Great Depression, right? Had to be the worst time in history to buy. Stock market fell 85%. Unemployment rate went to 25%. It took years for the stock market to recover. From there, your worst 30% return ever for the U.S. stock market was 850%. One more. 2 more, actually. Sorry. Risk is quantifiable. This is something I've spent my career working in the institutional money management field. So I managed money for endowments and foundations and pension plans. And very smart people, a lot of them went to Ivy League schools. And they thought, if we can just quantify everything, and this is going into 2008. I started my career managing money for the Fernando family in 2007, July 2007. So I was basically like Bob. I top-ticked the market more or less. I joined the firm. Over the ensuing 16 months, the stock market crashed almost 60%. But they all thought, if we can just have a handle quantitatively in our portfolio, we understand the risks, we'll be fine. We'll be able to manage it better. But the problem is that the market doesn't really work like that because volatility itself is not necessarily a risk, right? It can be a risk if you make mistakes because of the volatility, but technically it's like an opportunity, right? So I kind of appreciate this definition a little more. Warren Buffett says risk comes from not knowing what you're doing. My friend Carl Richards says risk is what's left over after you've thought of everything. You can't quantify that stuff, right? But that's kind of risk. It's like I'll know it when I see it. And I think as an individual investor especially, there's really, am I on track to reach my financial goals? Like, that's a risk. And what am I doing to minimize the probability that I won't reach these goals? And unfortunately, like a fancy math problem is not going to tell you that. I kind of say volatility is a feature, not a bug. And I think this is one of my favorite graphs. This is kind of perfect for today. So these blue lines here show the average returns by year for the S&P 500 going back to the late 1920s. You can see it's all over the map. Again, our average is 10%. Those red dots there, that's during each of those years, what was the worst loss? So you can see this is the favorite example here circled. So this is 2020. So you're down 34%, right? Remember in March? Happened in like 3 weeks. The stock market finished up almost 20% that year. So the average loss in this time over the last, call it 95 years, is 16% in a given year. 2/3 of the time, when you have those losses, even a double-digit loss, you still have a gain. So it's just something we kind of have to live with. So I think the stock market today, as of this morning, I was looking, is down 8% from the all-time highs. It's like, geez, the crash is coming. It's normal, unfortunately. This is how the stock market works. So this shows the stock market percentages of loss in a given year. Again, going back to 1928, basically a 5% loss every single year. There's been a handful of years that hasn't happened. Even a 10% loss, 2/3 of the time, more or less. A 20% loss you can expect to happen 1 every 4 years, call it. 30% is more like 1 every 10 years. And so the hard part as an investor is every time stocks start to fall, you think they're going to fall a lot more, right? That's just kind of in our DNA. We're, on the savannah, we're always looking for the tigers that's going to come get us. But this is just part of investing. And unfortunately, I think investing right now has gotten harder than it's ever been. And you might say that doesn't make any sense, because returns have been awesome for the last decade plus, right? And so one of the things that I tell people is that the market is a complex, adaptive system. I mean, it's always changing. It's hard to guess what's going to happen. It's hard to predict the future. So a lot of people, especially in the finance industry, assume, well, all right, we're going to meet complex with complex, and we've got to show people how smart we are. I'm more of a simple kind of guy. So every year around Christmas, we have an argument online. Everyone just decides we're going to do this. Is Die Hard a Christmas movie or not? John McClane, right? He's defending his wife's honor and her place of business from some terrorists. Hans Gruber. Personally, you can have your own opinion. I say it's an action movie that occurred during a Christmas party. If you want to call it a Christmas movie, that's fine. There's always a trope in the 1980s where the villain would lay out his plan for everyone, right? He had to let you know what's going to happen, and then Bruce Willis, our hero, would come in and thwart it, right? You have to tell everyone. So Hans Gruber kind of said, all right, they're stealing bearer bonds that earn 20%. So I can't do the accent here, but he said by the time they figure out what went wrong, we'll be sitting on a beach earning 20%. So Die Hard came out in 1988. You couldn't make Die Hard today. What would you say? We're going to be earning 1% for 700 years? You can't live on a beach earning 20% anymore, right? I guess you could say that the Fed has stopped white-collar terrorism. I don't know. But this is the world we're living in, right? Interest rates, Deutsche Bank did this thing where they went back to the 1700s. I don't know where they found this data. And they say interest rates are lower now than they've been in this past 250 years, right? I did this thing where I looked at, let's say you had $1 million in treasury bonds. And you said, I'm a risk-averse investor. Thanks for all that stuff in the stock market. I don't care. I'm putting my money in bonds. I want safety. I want security. I wanted to make sure that I know that the government can print enough money to pay me no matter what happens. So let's say you went back to 1960. What's $1 million in treasury bonds going to pay you on an annual basis in income, right? So 1960, you got almost 50 grand. By 1970, we're talking $80,000. Interest rates, remember, they're going up. 1980, now you're over $100,000, right? 10% interest rates, pretty good, right? That's enough to live on, right? 10% interest rates in the treasuries, I'll clip that coupon all I want. 90s, it's going down a little, still 8 grand. By 2000, it's down to under 70. 2010, interest rates are falling. Now, $1 million portfolio in treasury bonds. This is the 10-year. You got $17,000. That's not great, right? So the problem is, what do you do, right? There's no safety. There's no yield in safety. You have to go out on the risk curve. So the way I see it, you have two options, right? You can take more risk. You can adjust your expectations, right? Those are your only two options. Within those options, there's a lot of different variation, but so option 2, doing nothing. There was a study done by some German soccer aficionados, and they said, all right, we get to the sudden death in a soccer match, and you do the kicks, and you have each team gets 5 shots on goal, right? You have this, each striker gets 5 chances on each team, and it's really tough for the goalie to make a shot because the goal is so huge. So they wanted to know, what decision did the goalies make when they're trying to save? Because that thing's huge, and the striker has all the advantage, right? They have the upper hand. So the goalie basically has to make a split decision. So they have 3 options. They can dive right, they can dive left, or they can stay in the middle. And that's they want to know, okay, what happens? So they said 95% of the time, the goalie dives left or dive right. And I can't really blame them, because if you make one of those diving saves, you're the hero, right? You look awesome. The other 5% of the time, they kind of just stay in the middle. They said, okay, that's what the goalie does. What does a striker do when he kicks the ball? The strikers kick it down the middle 30% of the time, and then basically the other two-thirds going to the sides. So they figured, all right, let's say 1/3 of the time, the goalie just decided to stay in the middle. They could probably save an average of about 0.75 goals per game. And they kind of rounded it up and said, on average, I think they said they make 4 out of 5 kicks, right? Basically enough if the goalie just stayed in the middle to change the course of the game, the outcome of the game, right? But then they interviewed the goalies and they said, what do you think about this? Are you kidding me? I'm going to stand here like this and look like an idiot as they kick it by me? If I dive, it looks like I'm doing something at least, right? And so like this idea is like leaving your portfolio alone and not making any changes, like that's still a decision. And it's something you can do if you adjust your expectations or your spending, but those expectations are going to have to be adjusted. And there's nothing wrong with that. And the reason is you have to invest in something, right? And I think for a lot of people that means accepting more volatility. We're having clients come in that maybe in the past they would have done a 60-40 portfolio, and now they're doing a 70-30 or an 80-20, and they're just learning to live with a little more volatility because you have to accept that volatility to earn anything over the inflation rate these days. So we have this exercise where we show people, let's say we have a 2% inflation rate. How long does it take my money to be cut in half value-wise, right? So it's like 35 years. What if inflation is 3%? Well, now it's more like 25 years. What if it's 4%? 17 years? 5% is 14 years. I didn't do this for 7%, which we currently have now. I'm just going to assume that's not going to last forever. But suffice to say, it's not that. So you have to invest in something, unless you just have so much money that doesn't matter, right? And maybe Hans Gruber had enough money where 1% would do it for him, but a lot of people don't. The problem is, when people try to get too cute with things, it doesn't always work out. So it's really hard to beat the market. So this is the S&P 500 puts together this list every 6 months where they look at professional mutual fund money managers. If you can't read this, basically what it shows is what percentage of the time do these professional money managers beat their benchmark, beat the S&P or beat the small cap index. And if you can't read these numbers, I highlighted the 10 and 20 year numbers. They're basically all above 80%, some 90% over 20 years. Basically meaning owning the market would have beat all these professional managers 9 out of every 10 times. Like 9 out of 10 of them would underperform just holding the index for a low cost. So even if you're able to throw all these people who are educated, they're smart, they're paying attention to the market all the time, it's really, really hard to beat the market. Now, I get a lot of questions on this stuff. This is another answer a lot of people try to have. I think one of my favorite parts about Bitcoin is that it's a digital currency. At every news article tries to show a picture of an actual coin. It's not a coin. It's literally on a computer. John Oliver on his HBO show had my favorite explanation of crypto. He said, it's everything you don't understand about money combined with everything you don't understand about computers. I think this is something that some people are saying, this is going to be my solution. I don't have enough time to explain crypto at all, so I'm going to give you my short 60-second pitch. Think of Bitcoin as digital gold, right? So the old line is that over the long term, gold, an ounce of gold could have bought a male suit, a nice fine men's suit, when Jesus was walking the world. And it could do so today too. So it held its value, right? An ounce of gold could still buy Bitcoin will probably, I would say for millennials and Gen Z, it'll probably be digital gold, whatever gold is. So you think a lot of people say, I'm going to put 5% of my portfolio in gold, and that'll be a hedge, and it kind of marches to its own beat. I kind of think that's where we're headed with Bitcoin. All the other stuff, there's a million other things that are going on in crypto. I don't know what's going to work out, how it's going to work out. I'll just tell you our way of thinking about this. We just decided to make an index of this stuff, and there's all these different coins and tokens. And I would say that the one really smart thing, if you want to understand, like, why is this stuff going up, and why are people involved in this stuff, and it doesn't make any sense to me, the one thing that people in crypto have figured out is humans make their decisions based on incentives. And they've learned how to incentivize people to create liquidity, or they've incentivized people to put their money on these things because they're paying them a high yield. That's the one thing crypto people who started this stuff have figured out, that it's all about incentives that drive action. And we don't know what's going to be the winner in this stuff, or how big it's going to be, or if it's really going to take over the world. So we said, you know what, we're just going to create an index that kind of owns the market. It owns the two biggest, Bitcoin and Ethereum, and some of these other smaller things in this DeFi stuff that could upend the finance world or could not. But if it does, we're going to own the market. We're not going to try to guess what's going to do the best out of this stuff. So that was kind of our way of thinking about this. I don't think it's going to solve world hunger by any means, crypto, but I think it could, because of the way it incentivizes people, and because there's so many young people who grew up living on their computers. They're going to understand this more, right? I think the one problem that they tried to solve when they created crypto was, I could walk up in the audience and give one of you a $20 bill. Now, no one knows about that. I didn't have to check with anyone. I didn't have to go to a middleman. I didn't have to go to an authority or bank and do that. I just handed you a $20 bill. There was no way to hand someone a $20 bill on the internet without having an intermediary there. And that's what crypto is trying to solve in a lot of ways. That's kind of the easiest way to think about it without melting your brain. I think another way people are trying to increase their risk tolerance is investing in startups. There's tons of money pouring into the space. You can see all the money going in there. It's crazy. This started out with institutions I used to work with. Now it's going down to individuals trying to do this. We get all the time from our clients, hey, I got this deal from a friend I went to college with. If you take a look, check it out. There's so much money going into the space. I will say this is probably one space where it's easier to outperform the market, because getting into so many of these deals requires relationships and networking. But I will say there's so much more risk in this space, where the stock market might have a range of outcomes like this. Investing in startups has a range of outcome like this, and this is zero. Where in the stock market, you're not going to go to zero. So that's another option people are looking at. I also think personal finance has probably been never more important. So I wrote this book called Everything You Need to Know About Saving for Retirement. Give it out to a lot of our clients' kids, because they're trying to figure out what's going on. And I did this thing where I looked at savings rates versus investment returns. So I said, all right, let's say your household is making $100,000 to keep it a nice round number. You save 10% of your income. You earn 6% on that, which is a pretty, not a very high rate. What happens after 10 and 20 years? Then I said, all right, let's say you're the next coming of Warren Buffett, and instead of making 6%, you make 12%. I'm going to knock it out of the park. I'm a good stock picker. I can do whatever I want. You double it up, you can see your outcome is much better. Then you say, all right, well, what if I'm not the next Warren Buffett and I know that I can't beat the market? And instead of doubling up my market return, which is very hard, I just double up my savings rate. So I go to 10% to 20%. I still earn that original 6. You actually come out ahead. So doubling your savings rate led to a better outcome than doubling your investment return. Now, a lot of people have the ability to double their savings rate. Not a lot of people have the ability to double up the market return in the stock market. That's not easy. I wanted to leave a little time for questions. I'm going to leave you with this. One of my favorite books on investing is by Charles Ellis, called Winning the Loser's Game. In 2015, he did a presentation for us at a conference we were putting on in New York. And it was the simplest Excel spreadsheet presentation I've ever seen in my life. It was just all black. There was no designs. There was no pictures. There was no anything. And the guy was 82 years old. And someone asked him about it. And he dropped a 4-letter word and said, I don't give an F about PowerPoint presentations. And that's kind of how I want to live when I'm 80. He doesn't care. Anyway, Mr. Ellis said that there's three ways to win the game of investing. One of the ways is physically exhausting. You can outwork the competition. That's, I'm going to be there at 5 a.m. I'm going to go home at 8 p.m. I'm going to work a ton. I'm going to study. I'm going to be the smartest person in the room. Second one is mentally exhausting. You can outsmart the competition, right? You were just born better. You have a better mental capacity. The problem with these first two is that working more and working harder does not necessarily always lead to better outcomes. In some endeavors of life, that's true. If you work harder, you put in the hours, you can get ahead. With the market, sometimes it's the opposite. Sometimes the people who cut back and don't do as much end up doing better than the people that try too hard. The The other hard part, mentally exhausting part, there's always going to be someone smarter than you. There's rocket scientists and PhDs and people that are looking at this stuff on a daily basis that are so much smarter than any room you're going to walk into. And it's kind of hard to outsmart the competition a lot of times. The third option here is emotionally exhausting. You just have to be more rational than the competition. And I think that means simplifying, keeping a long time horizon, and basically just keeping mistakes out of the game. So those are kind of the 3 ways to win the game of investing. Thanks, everyone.